Number 1, an analyst estimates the intrinsic value of a stock to be in the range of $17.85 to $21.45. The current market price of the stock is $24.35. The stock is most likely. The analyst is saying anywhere in here, that's a pretty good price for that stock. The market's got it priced at $24.35. Above this range, it is most likely overvalued, undervalued, or fairly valued. Well, the market has it priced too high, right? It is overvalued. An analyst determines the intrinsic value of an equity security to be equal to $55. The current price is $47. The equity is most likely. So the analyst says that's what it's worth. The market is only valuing it at $47. The analyst says it's worth $55. Undervalued, fairly valued, or overvalued? That is an undervalued equity. Number 3. In asset-based valuation models, the intrinsic value of a common share of stock is based on the estimated market value of the company's assets, estimated value of the company's assets plus liabilities, or estimated market value of the company's assets minus liabilities. Well, we're looking for the value of the equity or a share of a common stock. It would be the assets minus liabilities, right? Company's assets minus liabilities. Which of the following is most likely used in a present value model? So we know present value model has some kind of cash flow in the numerator discounted back by some kind of by some rate of return. So we're looking for a cash flow measure. Enterprise value. That is not a cash flow measure. That is a cash stock. I shouldn't say cash stock measure. It's a value measure that is at a point in time. Price to free cash flow, that's a multiple. So we can eliminate those two. We have to take C. Free cash flow, there's our word we're looking for. We're looking for some cash flow. Free cash flow to equity. That is free cash flow to equity. 5. Book value is least likely to be considered when using a multiplier model, an asset-based valuation model, or a present value model. Well, a multiplier model, we know we have price to book value per share. So it's right in there. So we can eliminate that. We're looking for a least likely. An asset-based valuation model. Here we're considering the market value of the assets minus the market value of the liabilities, but book value is a good place to start in many cases, so we can eliminate that. Present value. What is present value doing? Again, it is cash flows. We're discounting cash flows back to the present, right? So that the value is the sum of cash flows discounted. Well, we wouldn't consider book value in that one at all. 6. An analyst is attempting to calculate the intrinsic value of a company and has gathered the following company data: EBITDA, total market value, and market value of cash and short-term investments, liabilities, and preferred shares. The analyst is least likely to use a multiplier model, a discounted cash flow model, or an asset-based valuation model. Least likely. So if we look at all of these things, do we have any cash flows here? We have an EBITDA, but that's not a cash flow. Total market value of cash and short-term investments, liabilities, preferred shares. Least likely to use discounted cash flow model. 7. An analyst who bases the calculation of intrinsic value on dividend-paying capacity rather than expected dividends will most likely use the dividend discount model, free cash flow to equity model, or cash flow from operations model. So we're looking at what is the capacity to pay dividends, not what the dividends will be. So we know we're not using a dividend discount model. We're being told basically we're using that rather than expected dividends, so we're not using that. There is no cash flow from operations model. It's only free cash flow to equity. And the reading specifically says, I shouldn't use the word specifically, but it does have a sentence saying that free cash flow is more of a measure of the capacity to pay dividends. So for a company that does not pay dividends, we would use free cash flow to equity as a proxy for their capacity to pay dividends. Number 8, an investor expects to purchase shares of common stock today and sell them after 2 years. So we have a 2-year holding period. The investor has estimated dividends for the next 2 years, D1 and D2. And the selling price of the stock 2 years from now, P2. According to the dividend discount model, the intrinsic value of the stock today is the present value of next year's dividend, D1. Well, you wouldn't just discount one dividend, right? So we can get rid of that. Future expected dividends D1 and D2. I think we can get rid of that too because we still have P2, right? Future expected dividends and price. The present value of D1 and D2 and P2. Exactly. 9. In the free cash flow to equity model, the intrinsic value of a share of stock is calculated as the present value of future expected free cash flow to equity. That sounds right. The present value of future expected free cash flow to equity plus net borrowing. The present value of future expected free cash flow minus fixed capital investments. Well, what this is doing, remember, we get to free cash flow to equity. Free cash flow to equity is our cash flow from operations minus our fixed cost investment, our capex, plus our net borrowings. So it's just trying to confuse you with something like that. We don't add net borrowings to free cash flow, and we don't subtract capital investments from free cash flow. We take cash flow from operations minus capex plus net borrowings to get free cash flow to equity. It is just the present value of future expected free cash flow to equity. Number 10, with respect to present value models, which of the following statements is most accurate? Present value models can be used only if a stock pays a dividend. Remember now, when we have wordy answers like this, we want to read and eliminate. Can we eliminate that? Yes, because if it doesn't pay a dividend, we can use free cash flow to equity. And we're looking for accurate. That's just not. It says used only if, an extreme word. Let's get rid of it. Present value models can be used only if a stock pays a dividend or is expected to pay a dividend. There's the only if again. And again, that's not true. I must accept C. I love these read and eliminate because I don't even have to read C now. But we'll read it. Present value models can be used for stocks that currently pay a dividend, are expected to pay a dividend, or are not expected to pay a dividend. Yes, because we can use free cash flow instead. C. 11. A Canadian life insurance company has an issue of 4.80%, $25 par value perpetual non-convertible non-callable preferred shares. Outstanding. The required rate of return on similar issues is 4.49%. The intrinsic value of a preferred share is closest to. So what are we dealing with here? We have perpetual shares, so we have a perpetuity. First thing I want to do is write down my formula for a perpetuity. There we go. So do I have my dividend? Well, it's a 4.8% $25 par value. So my dividend is 0.048 times 25. There's my dividend. Over, I need my R, required rate of return is 4.49, 0.0449. So it's 0.048, that's not a plus. Multiplied by $25 to get my dividend, divided by 0.0449, and I will get 26.72. Do I have that? 26.75. Let's call it a day. 12. Two analysts estimating the value of a non-convertible, non-callable, perpetual preferred stock, so I have a perpetuity with a constant dividend, that's a perpetuity, arrive at different estimated values. The most likely reason for the difference is that the analysts use different, well, here is our formula again. Different time horizons, different required rates of return, or estimated dividend growth rates. Well, it has got a constant dividend. It has no growth rate. You can eliminate that. It is a perpetuity. You can't use a different time frame. It is a perpetuity. You can eliminate that. The only thing that could be different is R, because R is sort of an estimate, right? The required rate of return. The dividend is going to be quite obvious on the preferred share. It's going to be stated. Everyone's going to have the same numerator. It's the denominator, required rates of return. 13. The Beasley Corporation has just paid a dividend of $1.75 per share. That's D naught. If the required rate of return is 12.3%, there's my R, and dividends are expected to grow indefinitely at a constant rate of 9.2, there's my G, percent per year, the intrinsic value of Beasley Corporation stock is closest to. So V naught equals, I need my dividend one period out over R minus G, which equals, what's my dividend one period out? Well, I have my dividend today of 1.75. But I have my G of 9.2. I'll multiply that by 1.092 to get D1, and divided by 0.123 minus 0.092, and that will give me 1.911 over 0.031, which will give me 6165. 6165. Why did I use the Gordon growth model? Because it tells me that I have a dividend. It tells me that dividends are expected to grow indefinitely at a constant rate. It doesn't tell me anything about two different growth rates. It only uses one growth rate, tells me that it's constant. I know that I need a one-period dividend discount model. That's the Gordon growth model. 14. An investor is considering the purchase of common stock with a $2 annual dividend. And that's common stock. The dividend is expected to grow at a rate of 4% annually. If the investor's required rate of return is 7%, the intrinsic value of the stock is closest to. Again, it's the same thing, right? V0 equals D1 over R minus G. So my D1, I have my D0, which is 2, times my G is 4%, 1.04 over, I have 0.07 minus 0.04. And that will give me 208 over 0.03, which gives me 69.33. 69.33. The Gordon growth model can be used to value dividend-paying companies that are expected to grow very fast, in a mature phase of the growth, in a mature phase of growth, or very sensitive to the business cycle. It can be used to value dividend-paying companies that are. Now we're using the Gordon growth model. It has one growth rate. So, mature, that are in a mature phase of growth. Which of the following is most likely considered a weakness of present value models? So I'm going to eliminate as I read. Lots of words here. Present value models cannot be used for companies that do not pay dividends. Well, no, we can use free cash flow, so I can eliminate that. Small changes in model assumptions and inputs can result in large changes in the computed intrinsic value of the security. Yeah, we said they're very sensitive to changes in R and G. So I can take B and move on, but we have a most likely. We're not looking for which is a correct or incorrect statement. We're not looking for a true or false. We have a most likely, so I'm going to read C to see if it's more likely. Chances are it's not, because there can't be a dilemma. I'm pretty good with B, and off I go, but I'm going to eliminate C. How's that sound? The value of the security depends on the investor's holding period. Thus, comparing valuations of different companies for different investors is difficult. No, it doesn't. It doesn't matter what your holding period is. You may have an explicit forecast period and a terminal value, but the terminal value at that point in time is the discounted future cash flows from that period onward. So it doesn't matter what your holding period is, you'll still come up with the same intrinsic value. Whether you say I'm going to hold it for 2 years or 5 years, V0 will still be the same if we're using your inputs. So B is the most likely weakness of present value models, is that they're highly sensitive to small changes in R and G. And that wraps up equity. A question that is often asked is, do we really have to know all of these formulas? Yes. Yes, you do. Yes, plain and simple. One of the more comical questions I've received in the past was, are we going to be given a formula sheet in the exam? I thought that was really funny. An analyst gathers or estimates the following information about a stock: current price per share $22.56, current annual dividend per share $1.60. There's D0. Annual dividend growth rate for years 1 through 4, annual dividend growth rate year 5 and onwards. We have two growth rates, so this is our short-term growth rate, this is our long-term growth rate, and our required rate of return is R. So it clearly looks like I'm going to use a two-period dividend discount model. Based on the dividend discount model, the stock is most likely under, fairly, or overvalued. So this is just a really, really tedious process to go through, but our V0 is equal to our first dividend, 160, 1.09, because we have to bring it out 1 year, discounted back by 1.12. It'll be 160 1.09 squared to get D2 over 1.12 squared, plus our third year dividend is 160, 1.09 to the 3 over 1.12 to the 3. And our last year's dividends, 160 over 1.09 to the 4 over 1.12 to the 4. That is the explicit forecast period. So all you have to do is just do calculator work on that one. That one is really tedious to do, but you'll do calculator work on that. And then you need your terminal value, which is Vn over 1 plus r to the n. Well, r is easy. The denominator is easy. Vn requires a little bit of work, so we'll move over here and calculate Vn. Vn is equal to dn plus 1 over r minus gl. Well, we know r and we know gl. We need our dividend 1 period out. All right, well, it is the dividend last year, whatever this dividend was, carried 1 more year. So it'll be 1.60, 1.09 to the power of 4, and carried 1 more year, 1.04, because that is the growth rate after the explicit forecast period. So this will get us to the end of 4 years. This will get us to the end of the 5th year. We need the valuation of the stock as of V4. So you need dn plus 1. If you need Vn, you need dn plus 1, right? So there's our numerator. Our denominator here is 0.12 minus our slow growth rate is 0.04, or our long-term growth rate. This will calculate out to 2936 for Vn. That's 2936. So we know that this term over here will be plus these 4 terms, plus we know it's 2936 over 1.12 to the power of 4. And this first term, if you calculate it out, will come to 1.55714. Plus this second term will come to 1.51543. This third term will come to 1.47484. And the fourth term will come to 1.435336. And this terminal value will be 18.6588. Add them all together, we get 2464. 2464, the current stock is 2256. The market has it at 2256. We think it's worth 2464. This stock is undervalued. So that's a long, tedious process of calculation, I think, but it's to show you the process. So there we go. And what I'm going to do is I'm going to eliminate some of this so I have some room. Let's just get rid of that. An analyst is attempting to value shares of the Dominion Company. The company has just paid a dividend of 58 cents per share. Dividends are expected to grow by 20% next year, 15% the year after that. For the third year, from the third year onwards, dividends are expected to grow at 5.6% per year indefinitely. So I got 3 growth rates. If the required rate of return is 8.3%, there's my R. The intrinsic value of the stock is closest to. So, okay, it's a dividend discount, right? So what's my first dividend? 0.58 multiplied by 1.2, discounted back by 1.083. What is my next dividend? It is 0.58, 1.2 times 1.15, because that's the second year growth rate, discounted back at 1.083 to the power of 3. Plus, what do we have from the third year onwards? Dividends are expected to grow at 5.6%. So at this point, I have a term, I have this term up here that I have to replicate down here. So let's do my Vn over 1 plus r to the n. My Vn is going to be, let me erase this up here, is going to be my dividend, 0.58, 1.2, 1.15, and the third growth rate, 1.056, over 0.083 minus 0.056. That'll give me Vn over 1.083 brought back, and that's to the power, that was a 2, and that's a 2 as well, brought back to 1.083 to the power of 2. And if you calculate all of these out, did I do that? Yes, I did. So let me look at my notes. This comes to 0.64266. This term comes to 0.68246824175, and our terminal value comes to 2669. So we add 0.64, 0.68, and 2669. We get 28. V0 equals 28.015. I know I'm all over the place, but I'm running out of room. 28.015. We have a 28 down here. Can we take that? There we go. The intrinsic value of the stock, it says it's closest to, because of all the rounding off. There we go. It's closest to 28. So this one had 3 growth rates. So the tricky part here was carrying the numerator forward each time. Hideki Corporation has just paid a dividend of $4.50 per share. Okay, D0. Annual dividends are expected to grow at 4% per year over the next 4 years. At the end of 4 years, shares of Hideki Corporation are expected to sell for 9,000 yen. So I have my GS over here. And I'm not given anything else. I'm given VN. I'm given V04 directly. I don't have to calculate it. If the required rate of return is 12%, there's my R. The intrinsic value of a share of this company is closest to. So V0 will equal, I have, how long is it? 4 years of discounting this dividend. So my first year will be 450. What's my my short-term growth rate? 1.04 over, my R is 1.12, plus 450 times 1.04 squared over 1.12 squared, plus 450, 1.04 cubed, 1.12 cubed, plus 450, 1.04 to the 4 over 1.12 to the 4, plus, I don't have to calculate VN, I'm just given 9,000, and I discount that back, 1.12 to the power of 4. And I will get, I'll try to give you the numbers so that you have them, that will equal 417.86, plus the second term will come to 388.01. This term over here, the third term is 360.295. That's a 6. The fourth term is 334.5598. And the last term here is 5719.66. I look at these answers and I say they're so far apart, I really don't care about the decimals. I don't have to round off here. I could just add the full terms and save myself some calculator strokes on this one. I'll get 7218 and 7220. Looks about the closest. These little fractions could not amount for the difference. 7218, 7220. I just saved myself some calculator work. I just made the decision that these are not close enough, that's going to make a difference. So rather than messing up on a decimal point, I just said, hey, path of least resistance. The best model to use when valuing a young dividend-paying company that is just entering the growth phase is most likely the Gordon Growth model, the 2-stage dividend discount model, or the 3-stage dividend discount model. Well, Gordon Growth model is for mature companies. The 2-stage model is for a transition company followed by maturity. And the 3-stage is for a growth followed by transition towards maturity. And it's just entering the growth phase, so we would use a 3-stage dividend discount model. An equity analyst has been asked to estimate the intrinsic value of the common stock of Omega Corp, a leading manufacturer of automobile seats. Omega is in a mature industry, and both its earnings and dividends are expected to grow at a rate of 3% annually. Which of the following is most likely to be the best model for determining the intrinsic value of Omega share? Well, it's in a mature industry. We're given one growth rate, earnings and dividends expected to grow at 3% annually. That sounds like a one-stage Gordon Growth model to me. So A, Gordon Growth model, B, free cash flow to equity model, or C, multi-stage dividend discount model. we can get rid of multi-stage. We have earnings and dividends expected to grow at a rate of 3% annually. You can use a Gordon growth model on that. You're most likely, I should say, to use a Gordon growth model on that. A price-earnings ratio that is derived from the Gordon growth model is inversely related to the growth rate, dividend payout ratio, and required rate of return. And you'll recall we had PE was equal to the dividend payout ratio over R minus G, so that the price earnings was positively associated, or had a positive association or positive relationship with the dividend payout ratio in G, and negatively related to R. So a price earnings ratio that is derived from the Gordon growth model, which this is inversely related to the, it would have to be R, because it's positively related to the other two. The growth rate, the dividend payout ratio, or the required rate of return. It must be the required rate of return. The primary difference between PE multiples based on comparables and PE multiples based on fundamentals is that the fundamentals-based PEs take into account, remember this is a justified PE, take into account A, future expectations, B, the law of one price, or C, historical information. Now this might be a little tricky, so let's see if we can't eliminate some of these. The law of one price, that is when we're using the PE to compare with other companies. So we can eliminate that. This is saying that it is based on fundamentals. We're looking for a justified PE. And what is our justified PE? Our justified PE is the dividend payout ratio divided by the required rate of return minus the growth rate. So would we be looking at future expectations or historical information? Well, we're including a growth rate into it. So if we have a growth rate in, the growth rate is pretty much for the future, right? So for 22, it's future expectations. Now, I will say that's kind of a tricky one. An analyst makes the following statement. Use of PE and other multiples for analysis is not effective because the multiples are based on historical data and because not all companies have positive accounting earnings. The analyst's statement is most likely inaccurate with respect to both historical data and earnings, accurate with respect to historical data and inaccurate with respect to earnings, or inaccurate with respect to historical data and accurate with respect to earnings. So let's see if we can't break this apart. There are two things in there that he's comparing it to. If we can eliminate one, it helps us, right? Use of PE and other multiples, it doesn't just say PE. Use of PE and other multiples for analysis is not effective because the multiples are based on historical data. Well, that's not true. They can be based on trailing 12 months or forward 12 months. So we can base them on expected or estimated future amounts. So that's not true. So we can say that his statement is inaccurate with respect to the first one. So it says here, B says accurate with respect to historical data. We can eliminate that. So we have inaccurate with respect to historical data, accurate with respect to earnings, or inaccurate with respect to earnings. So let's look at earnings, see if we can eliminate one. And other historical data. And because not all companies have positive accounting earnings, use of PE and other multiples. Price to sales, price to free cash flow. This is sales per share, cash flow per share, price to book value per share. None of those require positive accounting earnings. If it didn't say and other multiples, if he was just talking specifically about the PE, then we could take C. But because it says and other multiples, well, these other multiples don't matter about that. So this person is wrong on both. Inaccurate with respect to both historical data and earnings. A. 25. An analyst has gathered the following information for the Odin Corporation. Expected earnings per share, $5.70. Expected dividends per share, $2.70. Dividends are expected to grow at 2.75% per year indefinitely. The required rate of return is 8.35%. Based on the information provided, the PE multiple for Odin is closest to. Well, we can go about this two ways. We can calculate a price for Odin. We can calculate V0 equals D1 over R minus G, and then from that price divided by our earnings to get a multiple. Or we could just say, well, we already know that PE is the dividend payout ratio divided by R minus G, and our dividend payout ratio, we have 2.7 over 570. We pay out 270 of the 570. There's our payout ratio. R, and the credit rate of return, 0.0835 minus 0.0275. And that will give us 8.46. If we calculate it this way, D1, we're told the expected dividend per share is going to be 270. So we will have 270 over 0.0835 minus 0.0275 will give us 48.21. 48.21, and if we divide that by our expected earnings per share, 5.70, that's P. So our numerator is P, our denominator is EPS, earnings per share, price divided by earnings per share. That'll give us a PE rate multiple, 8.46. We get to the same thing. What do we have? 8.5. Can we take the 8.5 and be happy with that? I think so. An analyst has prepared a table of the average trailing 12-month price to earnings, price to cash flow, and price to sales for Tanaka Corporation for the years 2005 to 2008. So what do we got? Here's our ratios: price earnings, price cash flow, price sales, 5, 6, 7, 8. So price earnings, 4.9, 6.1, 8.392 has been increasing over the 4 years. Price to cash flow, 5.4, 8.6, 7.3, 7.9. So the price as a multiple of cash flow has also been increasing. And price sales, 1.2, 1.5, 1.9, 2.3. So price as a multiple of sales has been increasing over time. So we can see in 2005 the company traded for 4.9 times earnings. And in 2008 it traded for 9.2 times earnings. So its price has really improved. Whether the market allows it, maybe the market is saying maybe it deserves a 9.2. But price to cash flow has also increased, and price to sales has also increased. What else do we have? Okay, so now that we understand our little chart, let's keep reading. As of the date of valuation in 2009, the trailing 12-month PE, price to cash flow, price to sales, are respectively 9.2, 8, and 2.5. So we're now at 9.2, same valuation as 2008 for 2009. 8 on the price to cash flow, so 7, 9, 8. The price has increased even more because we're now paying 8 times the cash flow. From 7.9, we're paying even more for the cash flow. And 2.5 on sales. We were paying 2.3 times sales. Now we're paying 2.5 times sales. I say we, but the market. The analyst may reasonably conclude that Tanaka shares are most likely overvalued, undervalued, or fairly valued. Well, if these were constant, in other words, in 2005, if the market was paying 20 times earnings, and in 2006 was paying 20, and 2007 was paying 20, in other words, it was selling for 20 times earnings, and earnings was determining the price, we would say it looks fairly valued. If the multiples were decreasing over time, we could argue that, well, the market is willing to pay less and less of a multiple for earnings. Maybe it's undervalued based on that trend. This, we're looking at most likely would be overvalued. So I would argue that they're overvalued based on that. However, there is another way that you can do it, and I don't agree with this method. And even in the lecture that I did, in the videos I did, I said I don't agree with this. But you can just take an average of these 4 years, and if you took an average on the PE, the average PE is 7.1. The average price to cash flow is 7.3. And the average price to sales is 1.7. So 9.2 is higher than the average, 8 is higher than the average, 2.5 is higher than the average. So you could say, well, we're currently trading at higher than the average multiple, so we're probably overvalued or most likely overvalued. I don't like doing that. I don't like taking averages like that because there could be something particular about the company where its future prospects look incredible from 2007 onwards. The events that might happen in 2010, 11, 12 look really, really great, and the market justifies a higher price, which means taking historical ones and using averages I don't really like. But we got there just from logic. If the market's willing to pay a greater and greater and greater multiple year after year after year, it is most likely, my first guess would be, overvalued. An analyst gathers the following information about two companies. Which of the following statements is most accurate? So Alpha and Delta, current price per share, last year's EPS, current year's estimated EPS. Delta has a higher trailing PE and lower current estimated PE. Okay, well, I think we're going to have to do some calculations. I can see all of these things happening in here. So let's calculate the PE multiple here. This is our price. Here's our earnings. Our PE is just price divided by earnings. So 57.32 divided by 3.82, that is 15. 1893 divided by 1.35 will give us 14. 57.32 divided by 475 gives us 12.06, and 1893 divided by 140 gives us 13.52. All right, Delta has the higher trailing PE. Well, this is the trailing 12 months, and this is the forward 12 months, or the estimated. You can say the estimated, or let me write it a bit better. The next 12 months. How's that? Delta has the higher trailing PE. Let's find out. Delta has 14. Alpha has 15. Delta does not have the higher trailing PE. Gone. Alpha has the higher trailing PE. Yes, it does. And lower current estimated PE multiple. Yes, it does. We can choose B and simply move on. But we'll eliminate C. Alpha has the higher trailing PE multiple and the higher current. It has the higher trailing, it has the lower current. So we were right on that, B. An analyst gathers the following information about similar companies in the banking sector. First Bank, Prime Bank, Pioneer Trust, price to book, price to earnings. Which of the companies is most likely to be undervalued? So we're looking for undervalued. Well, let's look at price to book. First Bank is selling at 1.1 times its book. Prime Bank is only selling at 0.6 times, and Pioneer Trust is 0.6. So on price to book, for undervalued, it's a tie between these two. Let's go to the price earnings ratio. First Bank is selling at 8.4 times its earnings. Prime Bank is selling for 11.1 times its earnings. So we're undecided between these two. Pioneer Trust is selling for 8.3 times its earnings. So it's selling for the lowest PE. So Pioneer Trust was tied on the lowest for price to book and wins on price to earnings. Since we have both of them selected, company most likely to be undervalued would be Pioneer Trust, would be C for 27. The market value of equity for a company can be calculated as enterprise value minus market value of debt, preferred stock and short-term investments, plus market value of debt and preferred stock minus short. So this can be a little bit confusing here. So why don't we just figure out what enterprise value is? It is the market value of equity plus the market value of preferred plus the market value of debt minus any cash or cash equivalents. So it's saying the market value of equity of a company can be calculated as enterprise value and a whole bunch of other stuff. So let's just isolate market value of equity. Market value of equity will be enterprise value minus market value of preferred minus the market value of debt plus cash. So all I did was I just flipped this over to the other side. Well, I really didn't flip it over to the other side. I just moved all of this over to that side and then just flipped it so I could isolate market value of equity. Just basic algebra. I'm sure you'll get the same thing. So let's go. Enterprise value, we should have a minus, minus, and a plus. A minus the market value of debt, preferred stock, and short-term investments. No, that's three minuses. Plus market value of debt, we can eliminate those two right away. It's got to be C. Because you cannot add the market value of debt, we're showing that it's a negative. Minus the market value of debt and preferred stock, Yes, yes. Plus short-term investments? Yes. C. Which of the following statements regarding the calculation of the enterprise value multiple is most likely correct? So we're looking for a true statement here. We'll get rid of falses. Operating income may be used instead of EBITDA. That is true. EBITDA may not be used if company earnings are negative. That's false. Book value of debt may be used instead of the market value of debt. No. When we talk about enterprise value, it specifically says that book value is only a rough estimate of the value of debt. You would use the market value of debt unless all of the debt is private debt, bank loans and things like that. But if there are any bonds or anything out there, you would have to use the market value of debt. And even then, even when it is just private stuff out there, it's still recommended that you find a proxy, another comparable company that the debt is comparable to try to get the best market value. So it specifically says that using the book value of debt it's just a rough estimate. So book value of debt may be used instead of market value of debt. No, that's false. If market value of debt exists, you cannot use book value. You got to use the market value. So, which is most likely correct? A. An analyst has determined that the appropriate enterprise value to EBITDA for Rainbow Company is 10.2. The analyst has also collected the following forecasted information for Rainbow. EBITDA is 22 million. Value of debt is 56 million. Cash is 1.5. The value of equity for Rainbow Company is closest to. Well, we've already done that, right? Market value of equity is enterprise value minus the market value of preferred minus the market value of debt plus cash. This kind of makes our job a little bit easier because we have no preferred, so we could just take that right out. We have the market value of debt minus 56 million. We have cash, 1.5 million. So we need our enterprise value. We're told that enterprise value over EBITDA is 10.2. So 10.2 equals EV over EBITDA. And we're told EBITDA is 22 million. So enterprise value must be 22 million times 10.2. So all we have to do is multiply that out and we'll get our market value of equity. And we get 169.9 million. 169.9. Have I got something close to that? There we go. Enterprise value is most often determined as market capitalization of common equity and preferred stock minus the value of cash equivalents plus the book value of debt, market value of debt, market value of long-term debt. It is just the market value of debt. A disadvantage of the enterprise value method for valuing equity is that the following information may be difficult to obtain. Operating income, market value of debt, market value of equity. You don't need operating income. We can eliminate that. Market value of equity couldn't be easier. It is the price you can observe in the market at that point in time times the number of shares. That's easy. I mean, that's objective. There you go. Those two numbers you can observe. Market value of debt may be difficult, especially if the debt is not very publicly traded, not very publicly traded, not very liquid, or not publicly traded. Asset-based valuation models. Let me underline that. Asset-based valuation models are best suited to companies where the capital structure does not have a high proportion of debt, intangible assets, current assets, and liabilities. Does not have a high proportion of intangible assets because you have to find a market value for these things. That doesn't work out very well. Which of the following is most likely a reason for using asset-based valuation? The analyst is valuing a privately held company. Yeah. The company has a relatively high level of intangible assets. Oh, we already said no. Using asset-based valuation doesn't work well when there's lots of intangibles. Eliminate as I read, right? The market values of assets and liabilities are different from the balance sheet values. Yes, they typically are. That's why that's a justification for using asset-based valuation. It is not a likely reason for using asset-based valuation. They are likely different. The problem is it's hard to actually get market values for those. Those become very challenging to do. So, A, the analyst is valuing a privately held company is the most likely reason for using asset-based valuation. C, let me be clear about C, why I'm not choosing C. C is just a general statement that just happens to be true for any company that you're using, for any company. So it's not a likely reason for using asset-based valuation. Even if you're using a present value model or a multiplier model, C is a true statement for those two companies as well. So it's not that once you make that statement, oh, the market value and the book values are different, I got to use asset-based valuation. No, that's just a true statement about almost any company's balance sheet. Which type of equity valuation model is most likely to be preferable when one is comparing similar companies? A multiplier model, a present value model, or an asset-based valuation model? Well, when you're comparing companies, a multiplier model.